The economy is crashing, to put it quite simply. In this video here today, folks, I'm going to take you through a whole host of different things. We're going to look at Goldman Sachs earnings. We're going to look at KB Home numbers. We're going to look at some news coming out about essentially delinquencies on autos in non-payments. We're going to talk about layoffs. We're going to talk about unemployment. We're going to talk about a lot in this video here today. There's a lot I have to take you through, but I feel like no one's really paying attention to this. I feel like the masses aren't paying attention to this. I feel like mainstream media is not really paying attention to this. They're not really giving this enough light, in my opinion, on how hard the economy is actually crashing right now. And there are some silver linings in this, believe it or not, as all things in life is good and bad, right? And I want to share that with you. Also, for the folks that maybe are a little newer to the market and you're thinking, okay, this must mean the NASDAQ has to go down another 20, 30, 40%. It doesn't really work like that, and I'll explain that in this video as well. But nonetheless, make no mistake, the economy is crashing right now, and it's just not quite getting the light it should. And I feel like one of my jobs out there, as always on YouTube, is to provide you data, show you things that you wouldn't usually look at, so you can see how bad things maybe really are or how good things really are out there. And I hope you guys enjoy it. I hope you appreciate it. I appreciate every single person that subscribed to the channel. Also, if you want to support my content, do it on Patreon. That is the pinned comment down there. For only $10, you can support us on there, and also you get access to all the stocks I'm buying and selling in that Patreon portfolio there. Alrighty, so starting out here with Goldman Sachs. Now, first off, you can get any companies that's public companies, investor reports, their quarterly reports, their annual reports, things like that. All you have to do is type in Goldman Sachs investor, investor relations, and it'll come up there. So it's not like this is some information no one has access to. First thing I'm showing you is how bad Goldman Sachs numbers are. Now, we heard Goldman Sachs just lay off several thousand employees. That news came out about a week ago or so, right? But their business is falling off a cliff. These numbers are shockingly bad. Look at their global banking and markets division. Advisory is down 17%. Equity underwriting down 83%. These numbers are so bad, you start to think, this is a typo. Is this not a typo? Did Goldman Sachs make a typo? Did their auditors make a typo? 83% equity underwriting down. Debt underwriting down 48%. Investment banking fees in general down 48%. These numbers are incredible, right? Net revenues down 12%. Incentive fees down 42%. This is asset and wealth management. Equity investments down 93%? 93%? What? Debt investments down 68%. Total net revenues down 39%. Their platform solutions, as far as that goes, that business is experiencing very healthy growth for them, but the problem is that business is super small for them, right? Total net revenues down 20%. 20% net revenues down. That's for the full year, right? And you look at every single region, it's bad, bad, bad. Look at Americas, $28 billion in revenue versus basically last year, right? In Americas, $37 billion of revenue. In terms of EMEA, $12 billion of revenue, $14 billion of revenue last year. Asia, $5.8 billion of revenue, $7.6 billion of revenue last year. Every region, bad, 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 bad. Okay? These numbers are shockingly bad. And you're talking about one of the most impressive companies in the United States of America, Goldman Sachs. They're one of those companies that they'll find a way to make money in any situation, right? To see some of these numbers down that bad is shocking. And I don't know if this is a bottom for Goldman Sachs. I think 2023 could be worse for them, which is hard to even think about, right? It could very well be worse for this company. So incredible how bad the numbers really are for Goldman Sachs. Just extremely, extremely disappointing. And it definitely shows you the true weakness there really is out there. And like I said, it's not just in one region. It's across the world, man. It's across the world. Next up here, check this out. KB Homes reported earnings very recently here. KB Homes, a large home builder, just reported a 68% cancel rate. Remember the people talking about, oh, real estate's fine, real estate, blah, blah, blah. No, okay? Meaning that over 2/3 of home buyers walked away from their contracts in the quarter, leaving KB Homes with a massive pileup of inventory. Last year, cancel rate was only 13%. Now, this number was so shockingly bad that I was like, here's what I like to do. If I see something out there, whether it be on Twitter or anywhere else, or somebody sends me data or whatever, and the numbers sound so crazy, what I like to do is I like to actually research it myself, which is something all you guys should do as well. To be like, wait, is that accurate? Like that sounds crazy, right? Because 68% cancel contracts. Like, I'm very bearish on real estate. I think everybody knows that. I've been bearish for over a year now, and I'm going to continue to be bearish for this at least another year or two. And even for me, I was like 68%. So you know what I do? Instead of just taking it at face value, I say, let me go to the actual company's investor relations page and let me research this and let me see if that's actually accurate. And so what do we find here? Well, guess what we find? Damn it, that is accurate, okay? First off, ending backlog value decreased 25%. Ending backlog units were down 27%. So basically, KB Home's backlog is drying up and is drying up rapidly. Same exact thing we heard from Toll Brothers. And it's going to dry up more. Now, the reason this is such a big deal, even if you don't own KB Home stock or you don't own Toll Brothers or any of the home builders, the fact is these home builders use all these independent contractors. It creates massive amounts of jobs with all these homes being built. And when their backlogs are drying up, that basically means folks are going to lose jobs, and they're going to lose jobs rapidly over this next year that have to do anything in relation to home building, which is obviously not a good thing for the economy, because somebody that was, working on these homes making 40, 50, 60,000 a year is not going to have that opportunity anymore, okay, when the backlog's going down like that. Incredible. Reflecting sharply lower demand stemming from higher mortgage interest rates, inflation, and other macroeconomic geopolitical concerns. Fourth quarter net orders, 692, and net order value of 362 million decreased from 3,529 and 1.77 billion respectively in the same quarter last year. What? Net orders of 600. In an entire quarter, all KB Homes sold was 692 homes? 692 homes? That's nothing. That's nothing for KB Homes. Are you kidding me? In the same quarter last year, 3,500 homes. If people aren't paying attention to this stuff, I don't know what they're paying attention to. That's devastating. Devastating, okay? Gross orders for the quarter of 2,169 were down 47% from 4,072. The cancellation rate as a percent of gross orders was 68% compared to 13%. So yes, that number was right on. Incredible. Absolutely incredible. Now, if you also want to understand how the home builders are really feeling about the home market, I think it's very important to always look at what they're up to with land. Okay, look what they're up to with land. Land and land development expenditures for the quarter decreased 29% to 442 mil compared to 621 mil for the same quarter last year. Land acquisition investments included in these amounts decreased 74%, which tells you KB Homes is not bullish about real estate anytime soon. Because the bottom line is, if KB Homes was actually bullish about real estate coming back anytime soon, they would not have land acquisition investments down 74% year over year. That shows you that KB Homes is like, this ain't getting better anytime soon. We're going to expect some weakness for a while here. The company's lots owned and under contract totaled 68,000 compared to 86,000, primarily due to reduced land investments and abandonment of previously controlled lots. Of the company's total lots, approximately 70% were owned, 30% were under contract, compared to 56% owned and 44% contract. Oh boy, okay. Oh boy. That's not good. Real estate is messy. It's going to get messier. Next up here, look at this. People are not paying their car loans. Auto loans delinquent overdue by more than 60 days are now up 26.7% from a year ago. Not a crisis, but a trend close to watch. Now, think about this for a moment, right? We know, if you know anything about the auto industry, right? If you know anything about the auto industry, and if you've ever worked in the car dealership, or you ever looked into it, or you've known people that have worked in that industry, right? You're going to know that car dealerships can make a lot of money many times off of of folks that, let's just call it, don't have the best credit, but are in a situation where, they need a car, they're going to buy a car, something like that, right? Many times those people aren't very good at negotiating. They're just going to take it at face value. And many times auto dealerships can get a big kickback. Now, those folks are also the most likely folks to unfortunately not pay their car loans and get their cars what's called repossessed, okay? Now, what we're going to likely see over this next year is massive amounts of repossessions like we haven't really ever seen in the auto industry, or certainly since the great financial crisis, or maybe it's a possibility it could be even worse in terms of these folks that maybe are subprime folks that can't really afford these vehicles and bought them, and obviously bought them on loans with interest rates of 18%, 20%, 25%, which isn't uncommon. And I know that sounds crazy to some folks that have auto loans that are watching this video, and you guys are in good financial positions, right? And you're like, how could somebody have an auto loan at that? My auto loan's at 3%. My auto loan's at 2.5%. My auto loan's at 4%, blah, 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 right? Believe me, there's massive amounts of people. I'm talking millions in the United States of America that have auto loans that pay interest of 15, 18, 20, 25%. And those folks are, if anything happens that hurts their budget, such as inflation, they can't also afford to keep paying that. And if their hours get cut, and a lot of those folks work at hourly jobs, and if the economy is weaker, hours get cut. If hours get cut, suddenly you don't have as much money as you did before. If you don't have as much money as you did before, suddenly that auto loan doesn't get paid. And so I think that's a big factor that a lot of folks aren't anticipating here, and that's why the auto market can actually see more weakness ahead. No, for somebody like Tesla, doesn't matter so much, because it matters a little bit, but it doesn't matter as much because Tesla's not selling to these sorts of folks, right? And it's not really competing there. Tesla's competing against folks that are going to buy a new vehicle priced between, let's call it, $35,000 and $70,000. So this is a more of an issue for, the Nissans, the Hondas, the Toyotas, and those sorts of folks, because there's going to be massive amounts of used inventory, especially for the $30,000 and under vehicles coming, okay? Just wait on that. Next up here, Microsoft, one of the strongest companies, if not the strongest company in the entire world, is laying off 10,000 workers as it looks to trim costs. Now, the important thing about this is, I think there's a few important things. First one is, Microsoft hasn't even really seen their numbers hit. If you think about somebody like Goldman Sachs just basically let go of thousands of their employees, right? And you can understand it because you look through Goldman Sachs numbers and it's like, I can understand why they let go of thousands of employees. Look at their business. It's downtrending in a massive, massive way, right? A thing with Microsoft is their business isn't downtrending in a massive way. Look at their last quarterly numbers. It's not like they got that going on, but they just let go of 10,000 employees. And I think that's very telling. But I think the thing that's a little scarier here, and you've seen all these layoffs of all these companies, right? Look at how bad January is going to be. January could be worse than November. Think about this, guys. We still got, 2 weeks left here at play. We could potentially surpass November, which was the worst for the tech layoffs, right? When we had over 60,000 tech employees let go. We could pass that, right? And so here we are in this situation, right? But the thing you got to think about is this just round one for these companies? And maybe is there a second round coming and a third round coming? And the reason I bring this up is some companies have cut and then cut again, right? Look at a company like Twitter. They had several rounds of cuts. Look at Amazon, several rounds of cuts. And so you're looking at some of these companies that will cut and then they end up cutting again and again and again. And so we'll see how that plays out, but I think that's an important factor. But I think the last year has really been the year of white-collar jobs being lost and tech workers and whatnot. I think this next year is going to be much worse from the layoff standpoint, because what I think is going to happen is I think blue-collar jobs are ultimately going to start to be lost in a major, major way. And those are a lot more jobs, okay? And I think we're going to have hours cut. I think a lot of these blue-collar jobs we're going to see dry up as the year ticks on and just get worse and worse and worse. Remember what we talked about with KB Homes. That will that will negatively affect jobs in a massive way. Manufacturing jobs and construction jobs. That bleeds into something else, which bleeds into something else, right? If people are starting to have a lot of, cars repossessed over this next year, which is definitely a realistic possibility if folks are losing jobs, right? Then that puts into a situation where, guess what? You don't need to build as many cars in the United States. And we know the automobile sector builds a lot of vehicles, right? And so you start to have this kind of like boom, boom, boom cycle of just jobs being lost and cut left and right. Now, there's a few kind of silver linings in that, because I know there's a lot of people that think like that's just devastating and also think that means the NASDAQ has to crash more and things like that, okay? Here's two factors I want you to think about. First is I don't think we can end this kind of cycle we're going through until we see those blue-collar jobs, unemployment rise in a pretty substantial way. It seems like it's just a waiting game, essentially. And you can't really bottom out the economy, you can't bottom out the markets or anything for real, until you get that unemployment start to really go up, right? And the Fed seems very committed to having unemployment go up. So it seems like it's something that naturally just has to happen, unfortunately. And it seems like there's no way around it. And I think that's something that we'll see. Now, for the folks that are thinking, like, does this mean, market's going to crash a ton more? Keep in mind, especially when it comes to the NASDAQ stocks, you have to divide the market. The market is very divided. The past year was really like the devastation of tech companies, the devastation of tech stocks. And you saw some stocks hold up very well. Many of the Dow stocks, for instance, held up just fine. And the Dow Jones Industrial Average looks like it hardly got hit, right? In my opinion, you're going to see a divergence. A lot of these tech companies have already hit their lows. Not all of them, but many of them have already hit their lows. They will not hit a new low. Some will, but many won't. They've already hit that low. They already priced in the worst scenario for them. But I do think a lot of the Dow stocks and some of the S&P 500 type stocks can absolutely get hit. But if you're waiting on another NASDAQ down 20-30%, I think that's a little far-fetched. Can you get a NASDAQ to go back down another 5-10%? Sure. But in terms of that 20-30-40%, that's tough. Could you get a Dow to go down 10-20%? Absolutely. There's a massive divergence between the Dow and the NASDAQ over this past year. And don't be surprised if the Dow underperforms significantly over this next year. Because think about what the Dow stocks represent. Many of the Dow stocks don't represent the let's call it tech workers, the tech companies. Many of the Dow stocks represent blue-collar workers, blue-collar jobs, the ones that weren't hit in 2022, but will unfortunately be hit in 2023. And so there's just some food for thought there to keep in mind. Hope you guys enjoyed today's video. I appreciate everybody joining me for these type of videos as well. I usually try to be Mr. Positive, but I got to tell you how it is, and I feel like this isn't getting enough limelight right now in terms of this level of detail, and so I try to bring that out to you guys. If you enjoy the channel and you want to support, do it on Patreon. That is a pinned comment down there for $10. I appreciate y'all. Much love, and have a great day.